Hi everyone, in the previous two videos we started building the balance sheet and we are going to continue with where we left. On the liability section we are going to record the dividends payable. So we are going to look at that piece specifically in transaction number 6 that we recorded earlier. The company, as you may remember, declared dividends but has not paid it yet, so that's a liability to the shareholders and we are going to record that as such. And then there is wages payable section, and we can find that under wages payable. The salaries were earned but not paid yet, so that's going to be our wages payable. We are going to record that as well. Next one we have is interest payable. We are going to find that in the closing entries as well. Interest was accumulated, we recognize it, but we haven't paid it yet, so it's going to become a liability. Same here with the taxes. We calculate we owe taxes, but we haven't paid the IRS yet, so we are going to record taxes payable too. These are what's so-called the current liabilities, and then we have long-term liabilities. Notes payable is one of them. Notes payable is what we used when we were purchasing the PP&E from the previous transactions, so we are going to record that piece. And then we also had a bank loan that we need to record. We borrowed money from the bank and we are going to record that as a liability as well. And now it's time to sum these up to find total liabilities. So we are going to have a sum. Our total liabilities turn out to be $31,900. And let's take a look at the total equity. We are contributing capital, and that's the very first transaction we did. They issue stocks, and as a result they have contributed capital right here. And then we are going to take a look at retained earnings. So retained earnings can be calculated in several ways. I'm going to look at the journal entries first, so we can see how retained earnings is affected. Retained earnings increases when there is a sale, just like in transaction number 2. And then whenever we have an expense or dividends, it's going to be reduced. So we have a dividend that's going to reduce our retained earnings. Remember, retained earnings is the profit after dividends, so what the company actually retains. So those are the two that we have from the initial transactions. And then we have our closing entries. So rent expense is going to, any expense including rent is going to reduce retained earnings. Wages expense is going to reduce retained earnings. This is cost of goods sold when the inventory decreased. That's going to reduce retained earnings. We have interest expense. We have depreciation expense from transaction 5 in closing entries. And if you haven't watched the previous videos, I highly recommend. This is a continuation of those. And then we have tax expense. That's going to reduce retained earnings as well. So our retained earnings turns out to be $1,500. Our total equity is going to be $1,500. Total liabilities plus total equity, that's going to give us the same number that we have here. It's a check for you to make sure that you did the balance sheet correctly. So this is what we have from balance sheet standpoint, based on all the transactions we have been recording in the previous videos. In the upcoming video we are going to look at net income, and we are going to have a closer look at the retained earnings section, another way to calculate it as well. And last thing I want to say is the company started operations, so they didn't have any balance sheet items earlier. That's why we started from scratch. But when a company is continuing the operations, then you are going to take the beginning balances at any time and then modify them based on journal entries that you have.